Good morning from our global headquarters in New York. I'm Manus Cranny alongside Danny Berger. Welcome to Bloomberg Brief. Let's set the agenda.
A weak U.S. data delivers a growth scare to global equity markets. 10-year yield falls below 4% for the first time in months. Mag 7 and chip stocks bear the weight of the sell-off, wounded by disappointing earnings from Amazon and Intel. The focus now turns to the U.S. jobs report. Will the unemployment rate hold steady? Good morning, Manus.
Danny, a very good morning. The question you need to ask yourself, we are swinging around by $100 billion a day on NVIDIA and more. Was yesterday's move cathartic or the beginning of a much more significant crisis of confidence in equity market? Either way, the Russell dropped by 3%. The Nasdaq was under considerable pressure. We have the eye of a growth scare and policy area. You're going to hear these phrases throughout the day. We'll talk about them with guests. The equity bears were given plenty to feed on. The tech sector, look at Intel, down 21% now. 15% of the workforce will go. Cuts in the dividend will go. Is it idiosyncratic to Intel or something more malevolent about the growth narrative within those stocks? You're going to hear people now saying that Powell is behind the curve, the Fed is behind the curve, we're in policy error. There is also going to be a rising clarion call about what happens, perhaps even intermediate. I know you and I laughed about that, but you know what? Stranger things have happened. The bond market's significantly below 4%. It's a 7-day winning streak for the bond bulls. You haven't seen that since 2020 in the eye of the pandemic. You're looking at twos at the lowest in 14 months. And now the swaps market's pricing 3 cuts. And as I say, there's just a tiny pricing of an Fed cut. I know it's a high spec, but we'll throw it out there. And when you want to understand the real demolition in confidence when a currency goes bid, look at the Nikkei. This is some of the biggest moves in the Asian trade. The topic's the biggest move down since 2011. So you are looking at yen strength and a tech sell-off, which is malevolent in Japan.
You do get the feeling that something has changed. Something has become unglued. And the big change is that this is off the back of weak data, that you saw small cap sell off the back of weak data. Because previously, Manus, it had been data is weak. Bad news is good news because it means that we'll be getting Fed cuts. So is this a paradigm shift where equity markets now need to price in a harder landing and we can't all cheer by the fact that cuts are coming?
No, the one thing that I didn't even say when I was doing the market check is, by the way, we have got a jobs report today, 175,000. There is a consensus out there that this could be, as you said. Look, what do you get today? You get some kind of confirmation bias that we are really in a growth scare or not, as the case may be. And as I say, I will put it to you out there now, which is you're going to hear people talking about a 50 basis point cut in September. And if Drax are to be believed on the IB at the moment, the market is currently pricing the nano risk of an intra-meeting cut.
See, this is the thing.
I love that.
No, but it's so interesting because Powell was so calm and collected during his press conference. You had a situation where the journalists questioning him were more dovish than Powell himself. Yeah. And yet you have people betting for an intra-meeting cut. It's
nano. I've really got to emphasize this. It's so nano, okay?
It's small, but bonds are still rallying today into a jobs report where it's clear the risk is asymmetric given that big rally for it to, disappoint, not to give the bears what they want. Okay, so we also had tech earnings in the midst of all of this. So much to go through. Apple had upbeat outlook, standing out from the crowd despite sluggish China revenue. CEO Tim Cook does continue to be optimistic, and there's growth in the market, he says. Here's him on the earnings call.
During the quarter, I should say also that iPad returned to growth in Greater China as it did around the world. And so we continue to be confident in the long-term opportunity in China. I don't know how every chapter of the book reads, but we're very confident in the long term.
Let's get to Bloomberg's Tom McKenzie. Tom, where do you want to start? We have a lot of earnings, Apple, Amazon, Intel. Take your pick.
Well, look, we'll start with Apple, but look, as you guys were discussing, and we talked about this before these crucial tech earnings, what investors wanted to see was a clarion call of clarity from these tech executives that the growth was there, that investments around AI are paying off, and that they can drive upside in terms of margins. And what you've seen is a much more nuanced picture. Let's start with Apple then. The downside in terms of the China market, that was the fly in the ointment for an otherwise better picture from this company. They got growth of 5%. They've had 5 previous quarters, 5 out of 6 where they've missed. Revenues are back for Apple, growth of 5%. And in the current quarter, they're looking at similar growth as well, 5% above the estimates. But you saw that drop of 6.5% in that crucial Chinese market, where you've got a ban amongst state-owned enterprises in terms of their employees being able to use these devices, and of course, increased competition, and a consumer, frankly, that is facing pressures from all fronts in China. But you heard it there from Tim Cook. He's still confident in that market, and he says a lot of this is down to strong dollar. They emphasise that. A lot of this is down to strong dollar. Going forward, they think there's strength coming through. They saw that iPad pick up in China. Also going forward, and a lot of this was forward-looking from Apple, the AI, so Apple Intelligence, that will drive this upgrade cycle. That's what you heard from executives. That gets launched, the iPhone 16 in September. Then you get the AI pieces being put to play in terms of the upgrades in October, and they think that will lead to this upgrade cycle. The premium part of the smartphone market is still holding up relatively well. That's the bright spot looking forward for Apple.
You can imagine the Trump team being very happy with that now. It's even Apple talking about a strong dollar that's killing their numbers. Pat Gelsinger makes it very, very clear. I have no illusions that the path in front of us will not be easy. Some of the most consequential changes in our company's history. Intel could well be said to be idiosyncratic, but Intel and Amazon are both going through a lot of change. What do you think the most important takeaway for you was from Intel? It's being bruised again this morning.
I like the fact that you make a point of saying that this is an idiosyncratic story for Intel, because a big part of what's happening in Intel is that idiosyncratic story, playing that catch-up game to the likes of NVIDIA and AMD in terms of those GPUs and artificial intelligence. They have a play in that in terms of developing AI chips for laptops and smartphones, but that is still a ways off. They're spending very heavily on these foundries. They want to be competing with the likes of TSMC. That is coming at a huge cost. It was a brutal set of numbers from Intel, cutting a dividend that they've had in place since 1992, cutting 15,000 jobs, and projecting out softer earnings than analysts had expected.
Yeah, it certainly was brutal, to say the least. Tom, thank you very much. Tom McKenzie on the tech earnings. Our guest this morning is Alison Porter, Portfolio Manager at Janus Henderson. Alison, it's been a frenetic 24 hours. It's been a frenetic 5 days, or a month, as Danny said, when she came in and sat down this morning. Do you feel that in tech, we're at some kind of a pivot point of where the patience is going to really be tested in terms of the delivery on AI? Good morning.
Good morning. No, I think, if we went back to last summer, we had a very similar situation. We saw a tech sell-off, including NVIDIA, down double digits. And that's really consistent with what we see in these waves of technology. So I think just now you've obviously got concerns about where we are in the economic cycle, people worried and saying, be careful what you wish for, because we're getting close to a rate cut. Is that because the economy's slowing? But then for the technology stocks, we also have this fourth wave of technology moving into AI. And just as we saw both in the second wave for PCs and in the mobile internet wave, it accelerates returns for technology stocks, but also it can accelerate volatility. And in the 6 years of the mobile internet wave, we saw double-digit returns, but also a double-digit pullback within those years. And even last year, was a very strong year for technology. Over the summer period, we saw this double-digit pullback as investors continue to reappraise spending and returns. And I think we've seen evidence from Amazon, from Microsoft, from Google, and particularly Meta, of the types of returns that you see in some of the AI infrastructure spend that they have. But this is a long time, still early in that cycle.
Well, Alison, to that point, just to go through some of the numbers, Meta, they said that CapEx spending will be as much as $40 billion. Microsoft said $55.7 billion this year. Amazon said it will be more than $60 billion this year. What distinguishes between responsible spending and irresponsible spending on CapEx at this point?
So it's dependent on what return these companies can derive from this over the longer term. You saw in the case of Alphabet, their search business year on year is going to add $20 billion this year. In prior years, even pre-pandemic, it's been adding between $12 and $14 billion. That's a major step up. You see in Meta an acceleration in their engagement with users in pricing and volumes. So again, really seeing the payoff for that early AI investment that they have made. So, these investment phases are long. As we saw during the mobile internet phase and PC internet, advertising tends to be one of the areas that benefits first. And we definitely saw that in Google search business and in Meta. At Microsoft and at in AWS and Amazon's cloud business, we saw a significant acceleration there from Amazon, up over 19%. And whilst there may be a focus on some of the operating income and the capex, I think just remember this business is now, over $100 billion, and whilst it's only 17% of Amazon's revenues, it's actually over 60% of their operating income, and margins are, significantly better than anywhere else in the business, and that's driving really strong returns on that AI capex spend that we think is still in very early stages.
If you had to make a call in terms of who is winning in the AI race, if you look at the AWS within Amazon, the cloud business within Amazon, sales up 19%, that's a very comfortable beat. Microsoft said, look, we haven't got the capacity to meet demand. So I'm curious to know who's winning in that space and whose strategy do you bank on more?
So, AI has multiple layers, and there will be different winners in each of the layers. In terms of cloud infrastructure, we've got 3 clear winners in Microsoft, Alphabet, and AWS. And we think, they're all carving out niches within that. And the market's more than big enough. It's not a winner takes all. There won't just be one cloud winner. And we think that that shift to the cloud is still in early stages. And all 3 of those companies will perform well. AWS has an open source strategy. Obviously, Microsoft and Google both have their own large language models that they're developing. But we think that all 3 will continue to do well as many organizations will move to multi-cloud. And then you also have Meta that has the distribution that can really help it drive Meta AI, its assistant, development, and those advertising dollars. And as we've seen before, it takes a long time to see new winners in applications emerge, and we think that will emerge over the next 3 to 5 years.
Well, I'll tell you what, when you look at Amazon down 8.7 pre-market, you get the feeling that investors aren't willing to extend that patience to them. Yeah. Alison, I'm afraid that's all we have time for. Thanks for joining us this morning. Alison Porter of Janus Henderson. Okay, Manus, let's get to some of the other top stories trending on the terminal this morning. BNP Paribas is in exclusive talks with AXA to buy the insurer's asset management unit. It would be for $5.5 billion. It's set to create one of Europe's largest money managers with about $1.5 trillion in assets under management.
Warren Buffett sold shares in Bank of America for the 12th straight day. A massive stake in the lender by a total of 8.8%, amounting to $3.8 billion since mid-July. So far, Berkshire Hathaway has kept silent about its reasoning behind the whittling down of their holding.
And an influential Chinese central bank advisor urged his government to set compulsory targets for inflation and step up spending to address weak consumption. The rare critique from a monetary policy committee member also highlighted that focusing on investment and neglecting consumption was out of step with the weaker demand that now defines the economy. And Manus, we track a sell-off this morning that is still ongoing.
It is indeed. S&P down 1% at this stage. What belies underneath that are things like Intel down 21% pre-market. Nvidia, it's a small sell-off, relatively speaking, down 3.6%. So the tech, but then of course it was Russell that took the real basting yesterday.
Yeah, Russell down some 3% yesterday. Semis down 7% after a day when they were up 7% on Wednesday. It is an equity market that is giving some serious whiplash. It's your Bloomberg Brief, Danny Berger and Manish Cranny in New York. So oil is headed for its longest streak of weekly decline since December. With that latest geopolitical tension, though, means that oil prices are indeed rising this morning. Joining us now is Bloomberg Executive Editor Will Kennedy. Will, sure, oil sold off yesterday some 2%, but the day before that it was up 4%, and today it's up more than 0.5%. What do you make of oil not necessarily participating in this growth scare that's capturing the rest of markets?
I think the growth scare is there. I think when you talk to people in the market, they are worried about China demand in particular coming through very weakly and not seeing the growth that you would expect in oil demand, typically from China, which for decades has been a huge driver of demand. But I think what's different with oil is you have got these geopolitical tensions, worry about the potential for escalation in the crisis between Israel and Iran, and what that could potentially do to disrupt supply. Now, it hasn't impacted oil supply yet, and it would be a pretty extreme scenario that did interrupt oil supply. But it is a worry that's there for traders, and I think as you go into weekend, that's probably why people don't want to be too short.
Yeah, I think it's going to be interesting to see the Iran response mechanism and just how high that is. Will, we're counting down to Chevron and Exxon. The idiosyncrasies of these two stories, one is about a major M&A deal, which is extend and pretend Chevron Hess, and the other one is about refining margins. How do you think the market is going to look at these two as a narrative for the end of 2024?
Well, clearly we saw quite a big sell-off in Chevron yesterday on this news that the arbitration for its Hess takeover, which is a takeover that clearly investors would like to see, was delayed until spring next year. People had hoped that that would be resolved this quarter by the end of this year. So I think they'll want to hear today what they have to say about that. As to the broader picture for both companies, I think they'll, as we saw with Shell yesterday, report steady earnings driven by these relatively high oil prices. Yes, the refining businesses, and that's a very big business for Exxon in particular, will take a hit. But the consensus is that it will be broadly in line with what we've seen before, and they will continue to return cash to shareholders at the rate they have been. The other thing that people always look at with these two companies these days is how they're performing in the US. They've both built up big businesses in the Permian Basin, that very important field that drives oil supply for the US and the globe, to see how the outlook for supply is there.
Okay, well, thank you very much. Let's see what those numbers are. And as you say, a big issue on this arbitration on Chevron Hess. Hell of a lot of money at risk there. And tune in, we've got the interviews for you lined up here on Bloomberg. The Chevron CEO, Mike Wirth, joins the team at 10 a.m. Eastern time. It's worth just checking back in on these markets. Interesting how, geopolitics is perhaps giving a little bit of a floor to some of that oil market, but these equity markets are under pressure. Now, the question is this: do you get a confirmation bias in the jobs report? I think that you've got a growth scare which is escalating. Fed behind the curve is the narrative. You get your jobs report today. Does that add injury to this kind of sell-off in the equity market?
In order to really get this equity market sell-off going, you'd have to argue that we're going to get something other than a soft landing. Michael Hartnett from Bank of America with his note out today saying to sell the first cut because there is a hard landing that is not being priced in. But the risks are so asymmetric, Manus. We've been selling off in equities into this jobs report. We've been buying bonds. We're doing both of that this morning. We are long bonds at a time when already 150 basis points of cuts are priced in over the next 12 months. How much more room is there really to price in more? Are we not already priced to perfection?
It depends whether you get this move higher in the unemployment rate. The one thing that has been the holy grail within the Fed and the Fed narrative and the soft landing is that the unemployment, yes, it has risen. It has risen from 3.6% to 4.1%. The next thing is, Danny and I will be talking about the SAM rule. Danny will tell you that Claudia Sam herself says don't bank too much on it. And then you get every economist and their wife and their husband come along saying, yes, the SAM rule, unemployment has risen by 0.5%. It's time to cut. The question is whether they actually do something larger. And I think it's a significant discussion to have. May they be pushed into doing something larger in September than we think at the moment?
Well, you know who also doesn't care about the SOM rule?
Go on, then.
Jay Powell. He said it in the press conference. It means nothing to him. Same with the inverted yield curve. Okay, coming up, we're going to take a look at what's making headlines around the world here on your Bloomberg Brief.
It's your Jobs Day edition of Bloomberg Brief. I'm Manus Crenny alongside Danny Berger. Let's see what's making the front pages around the world. And first up on the front pages, we have the images of Evan Erskine arriving home here in the United States yesterday. And it really was a hero's welcome, wasn't it, Danny? The images, very, very potent. His freedom came as part of the largest prisoner swamp between the East and the West since the Cold War. 16 were released in Russia in exchange for 8 Russian prisoners, including hackers, alleged spies, and convicted murderers.
I really recommend reading the Journal story on this. It ends by saying that Gershkovich, his last act as a prisoner, was writing a letter to Putin asking asking for an interview. Okay, next up on the New York Times, Pennsylvania Governor Josh Shapiro, a potential VP pick for Vice President Harris, has canceled his weekend's fundraisers. Now, it's not totally clear what this means for the VP race, but Harris had told top contenders to limit their travel before her decision next week.
And Japanese stocks suffering their biggest fall since 2020. Now, this was driven, we've got the global sell-off here, global growth scare here. You've also got that strengthening in yen. I mean, there's fuel. There's the double punch for the Japanese markets, really, isn't it? In points terms, you're looking at some of the biggest moves since 2000. In percentage terms, it's some of the biggest moves since 2020.
And you have to remember that just in Asia stocks in general, Japan is one of the most liquid. So if you are having this scare and you're thinking, what of my portfolio can I sell? Japan is kind of an easy target. It's more liquid than the Chinese markets, the other South Asian markets. So you might be seeing just some of that technical factor going into the Japanese market too.
I think also this sort of the alpha that we saw in dollar yen, there's dollar yen 148.95, and there is this narrative that you potentially can trade down to 140. And what if you get a softer Fed? That really is going to add to that. In terms of the actual closes, this is what we've got for you. Topics down 6% and the Nikkei down 5.8%. Of course, banks and tech are huge pieces of that particular market.
I'd say probably the only person that's really excited about today's market moves is Governor Ueda, because it does help strengthen the yen, and especially if we get a weaker jobs report, it will do the same too, Manus.
Indeed. But the concentration risk is, look at that, the DAX is the tech-heavy aspect of Europe. European stocks down 1.5%. We're counting down to payrolls with Citi's Veronica next.
From our global headquarters in New York, I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
Weak U.S. data delivers a growth scare to global equity markets. 10-year yields fall below 4%. Mag 7 and chip stocks bear the weight of the sell-off, wounded by disappointing earnings from Amazon and Intel. And the focus now turns to the U.S. jobs report. Will the unemployment rate hold steady as she goes?
Man, what an August it's been, and it's August 2nd. You get that feeling that the days are really stretching out. You have an equity market sell-off and a bond market rally that is continuing in force today. That is notable that we're carrying it through more than 24 hours. S&P 500 futures fall by more than 1%. NASDAQ leads some of those declines with really bad numbers from Intel. Intel down more than 20% this morning. NASDAQ down nearly 2%. Russell 2000, you can see on the bottom of your screen, that is also underperforming, down 2%. Because it is a growth scare that's happening in tandem with the concerns about tech earnings. You had the ISM numbers and some of the jobs data coming in concerning. So as you say, Manus, this jobs data is crucially important. 10-year yield, that is below 4% for the first time since February. 3.9% is where we stand. Goldman Sachs, Manus, says that if you thought this earnings season was volatile, it's not just in your mind. The average stock has moved 5% after reporting its earnings. That is the most on record.
And you are having $100 billion days swing around on the likes of NVIDIA, nearly $400 billion just the other day, Danny. So in terms of if the hedge funds have gone to the Hamptons, they've left a little bit of volatility on the table. I mean, there's no doubt about it. You know, how much credence do you put on the manufacturing data versus the NASDAQ? The NASDAQ is not manufacturing. Manufacturing is not services. Inflation, everybody. That's what you're supposed to be focused on. There you
and
go.
It's delivering life lessons on a Friday morning. No, but look, it's this idea that the only place this market has to go is to price in a hard landing. Michael Harton at Bank of America is saying sell the first cut, that a hard landing needs to be priced in, and it's underappreciated.
Look, I think what you're going to get between now and the next Fed meeting, because you do have two more inflation prints, etc., 2 more ratification points, is you're going to get this swing factor between they're going to go 50 basis points. No, they're going to go 25 slow and steady. They may even go for an intermediate cut. No, that's not going to happen, because this market needs to be so preached to and so converted to and so told that they couldn't handle an intermediate cut.
It's been a year that what's worked really well is just fading all the extremes. Fading the extreme of 6 cuts, fading the extreme of no cuts, and maybe now fading the extreme of a hard landing.
There you go. There's a distance between now and a hard landing. Mike McKee joins us around the desk this morning to discuss the jobs report. So, look, Danny and I are talking about these numbers. The jobs number in of itself could be a heck of a confirmation bias to the ruckus that we've had this week.
It could, because we've gotten some bad preliminary jobs numbers this week that have really scared people. But when you look at the forecast, 175,000 for the month of July, and that's basically in line with forecasts for the last 6 or 7 months. And in 5 of the last 6 months, the jobs number, establishment numbers come in higher than the forecast. So if you're trading patterns, you might go with that and have a better day. Unemployment is going to be really interesting, and you know why. 4.1%, what we're talking about. Manufacturing jobs, we had that bad ISM number, and earnings could be affected by the hurricane down in Texas because earnings at ours are going to be more affected than the number of jobs. But the SOM rule is what everybody's going to be talking about, and whether or not we get high enough unemployment to trigger the SOM rule. It's going to take about 4.28%, I think, to get there.
I know. It's the rounding that kills me.
It's the rounding that kills you.
Because you know, Mike, there's going to be people who look at 4.2% and say, that's close enough. We're basically there.
If you want to panic, there's certainly the opportunity. But the interesting thing, and this is what you guys were just talking about, is yesterday we saw that bad ISM manufacturing number, and Tim Fiore, who runs the survey for ISM, said this: demand remains subdued as companies show an unwillingness to invest in capital and inventory due to current federal monetary policy and other conditions. Also yesterday, the governor of Illinois came out and blamed the Fed, saying high interest rates were causing layoffs at companies in his state. So there is a feeling growing out there that the Fed may be a little bit off sides. And if we see a bad number today, then you're going to get that kind of reaction in the markets.
Telling you.
Yep. All right. Well, I'm going to hold on to my seat for one. Mike, thanks so much for joining us, Michael McKee. And tune in at 9 a.m. Eastern. We're going to have our interview with Acting Labor Secretary Julie Su after those numbers come out 30 minutes before. Okay, joining us to continue the conversation is Veronica Clark, US Economist at Citi. Veronica, can I first say you just get huge kudos for talking about the weakness in the economy when this market was just seeing sunny skies. And now the market has come down to you. So first of all, congratulations for sticking to your guns. Second, is there any jobs number that we could see today that would mean 50 basis points cut is in contention for September?
Yeah, it does seem like that bar for a 50 basis point cut is getting lower and lower. We have had a string of consistently strong headline payrolls numbers, headline jobs growth. I think we'll see similar today. We're expecting 150K. That's still very healthy. Maybe anything around 50K, well below 100. But I think those headline jobs numbers have actually gotten maybe increasingly misleading. We're more focused on the unemployment rate, of course, and that's come up pretty consistently. We do think that comes up again today, not quite triggering that SOM rule, but something around 4.2%, and that definitely gets the market more worried.
Look, I know we were having a little bit of a joke before we came back on air, which is, how important is the SOM rule for you? Danny reminded me earlier in the week, Claudia Sahm herself has said, look, by all means, it's relevant, but don't overuse it or abuse it. You're in the market and you're trying to advise clients. So how prescient is it for the market? Yeah,
the actual triggering of that, half a percentage point increase from the low of the last 3 months on a 3-month moving basis. Is that exact contour, exactly right? I don't think necessarily. Powell called it a statistical regularity this week, so he's maybe not putting his full weight behind it. Sure. But this idea that we do in a usual cycle see a very gradual weakening of the labor market before you reach a point where things can accelerate and weaken much faster. I think that's still true, and that is kind of where we're right on the brink of now.
Because I wonder, what in the numbers do you need to see to say, okay, this is not a supply thing. This is not just more people coming into the country. Mm-hmm. This is a demand thing, and layoffs are happening. Yeah, I mean, in a sense, the increase in the unemployment rate really hasn't reflected the increase in supply. There's not been an increase in labor force participation or in population in the household survey. So it is reflecting that people have lost jobs. And when you do lose your job in a normal, that's a normal way of life. It's been really hard to find a new one. Hiring has really pulled back. We saw that in the JOLTS report earlier this week. Another drop in the hiring rate. What we don't see yet, which would be almost too late if we do start to see it, are the big layoffs. That's the non-linearity of a weakening labor market. It can quickly build on itself. It's not that we don't see no signs of building layoffs. We have had an increase in initial continuing jobless claims, even some of the details of the last jobs report. But that's still where there's maybe some hope for the labor market.
Well, certainly the hiring part of the manufacturing data yesterday was more worrying, perhaps in conjunction with the jobless claims at a one-year high. So let's move it forward. Let's take the angst that we've had, where we've got a growth scare. The Fed is behind the curve, theoretically, at the moment, if the rest of the data compounds and adds to this. What does that do to the narrative? We've been talking about, oh, it's a tweak. Oh, it'll be a tweak. Oh, there'll only be a tweak, 25 basis points. Now we're at 3 cuts. Okay, and if this data does get worse, then suddenly the debate about where our star is becomes a lot more prescient and potentially lower than where the market is coalescing around at the moment.
Yeah, I think in those initial first cuts, we still probably won't have the best, clearest idea of where the Fed will end up, how far rates will fall. Probably not to zero, right? This is probably not a 2008 kind of shock. We would think it's a more run-of-the-mill kind of recession. Yep. You cut to something around neutral, maybe a bit below. But yeah, what you can see is that maybe some of those cuts just really get more front-loaded. So you can see, starting with a 50, maybe a series of 50 basis point cuts. The Fed, of course, we're coming off a high inflation period. We will still be a bit, cognizant of not stoking maybe shelter inflation housing market too quickly, but yeah, this is going to be a Fed that's very quickly turning to trying to support the economy.
We haven't completely seen that yet, though, from the language. I mean, Powell and the other members of the FOMC have started to talk about weakness in the labor market, but they don't seem rushed. Powell was calm, cool, and collected despite all those journalists lobbying dovish questions at him. Does that worry you?
Yeah, I mean, in a sense, I think, when you do look at the data, and I think this is probably what Fed officials are trying to say, is, this is still a historically low unemployment rate. The level of, job growth, of the unemployment rate, of activity is all fine. I think for us, it's just that the trend has been consistently trending in a more concerning direction. So is it the level that's the right signal, or is it the trend that's the right signal? I would be a bit worried that it's more the trend.
The narrative has also been that corporates aren't in bad shape. I know we've had some tech earnings this week, which perhaps unseat our nerves. But households per se, we know they're bifurcated. At the lower end, there's pressure. They're becoming more diligent in terms of what they buy. But households are in pretty good shape overall. Corporates are in pretty good shape overall. So what is it that shifts us from soft landing to a hard landing?
Yeah, I mean, and there is a sense, households, you refinance your mortgage, your balance sheet looks a lot better, you pay down debts, similar for corporates. But I think it gets a little bit lost that, GDP is a flow. It's the marginal activity that you're doing. And for households especially, that's going to be really dependent on if you have a job, if you feel like you have employment security. And we have seen household spending, pulling back in the last 6 months. Something like that could get businesses to, on the margin, cut labor costs a bit more and do that through layoffs, and that would be really what accelerates it.
Okay, Veronica, thanks for being with us. Pressing calls as ever. Let's see what the number is a little bit later on today. Veronica Clark of Citi. Checking in on these markets. We've talked about a growth scare several times through the morning, Danny. This is the equity markets. S&P futures down over 1%. The Nasdaq really taking the weight of this growth scare and reporting scare, I would say, in the Nasdaq rather than the growth scare, because Intel down over 20%, cutting 15% of the workforce, cutting the dividend, and various other big tech not exactly living up to the ambitions that have been set for them by the estimates.
Yeah, I'll tell you that Intel move is quite remarkable, but it was, some ugly earnings. Off the back of that, Treasury is also rallying this morning. Finally, the correlation is back to normal, maybe not in the fashion that people would hope when it's such a violent move, but bond markets are moving higher, yields lower. We're up by at least 2 basis points for your 10-year yield. We're below 4% for the first time since earlier this year. Just to give you a flavor of what's priced in. 3 cuts for this year, about 6 in total over the next 12 months. There are higher recessionary odds. You get the feeling priced in here, that higher for longer narrative, that has been completely smashed. I thought Veronica Clark put it perfectly. It is the trend you should be worrying about, not necessarily the level of where we're at.
September's pricing more than 31 basis points cut, so slightly over the traditional quarter of a point cut, and you're going to begin. There's even a small possibility out there of 50 basis point cut and an intra-Fed cut meeting. There you go. Why not have a fly in the ointment on that? Who knows? It's a punt.
Yeah, why not give the market 50 basis points from here on out? Okay, coming up, we're going to talk about that Intel double-digit plunge after their earnings.
It's Bloomberg Brief with Manus Cranny and Danny Berger in New York, and it has been a brutal morning for global markets. Intel is in the eye of that storm, down over 20% pre-market, headed for its biggest drop in 24 years. This is on the earnings report. Tom McKenzie joins Danny and I now. Tom, the CEO was very, very clear, which is, you know, if you think the worst is past, buckle up, because this is going to be a bumpy ride. 15% of the workforce are to go, and that's for starters.
Yeah, 15% equates to about 15,000 in terms of their headcount. They are scrapping a dividend that they've been paying since 1992. The stock is already down, Manus, 42% year to date. And then we see the moves that are being lined up for the session today. As you say, the biggest drop, arguably, if we get that, of course, in about 24 years. It's really challenging. For Intel, there isn't the growth driver that some of these other tech companies have that maybe offset some of your concerns in terms of the spend that's coming through as they try and build out the foundries part of the business. They have an expectation that maybe they can play in AI when it comes to laptops and smartphones, but they're not there yet. That's still some way off. And so that's where you see the challenge coming through. Jeffrey's saying that even the cost cuts that they're pushing through right now seem unlikely to solve any of the fundamental challenges Intel faces. In the current quarter, they flagged growth in terms of sales of 12.5 to 13.5 billion. Estimates had been for 14.4 billion. A pretty damning assessment from Jeffries.
It's honestly like a horror show of an earnings. I mean, to see something down 21%. Apple is only down about 0.2%. And in today's market, that might as well be up 20% because everything is falling really violently. What gave investors maybe less concern about Apple as some of these other tech stocks, Tom?
Apple has the future play as well, so they are also asking for patience. But Apple has the here and now in terms of the sales and particularly of smartphones, and that's turned around. So it's a decent quarter. Revenues coming in, the growth around revenues for Apple up 5%, and they're projecting the current quarter will be similar, around 5%. Again, above the estimates. They did say, hold on, because the AI theme is going to kick in later this year. They project an upgrade cycle for iPhones as consumers move to the iPhone 16 to take advantage of some of the software capabilities that will come through from October. The China business, yes, remains a concern for Apple. Sales there dropped 6.5%, but executives said a lot of that is down to dollar strength. And that long term, they still see that as a healthy market. Here's the take from Morgan Stanley. This was a clean quarter, say their analysts, better services growth and record buybacks. Dan Ives saying AI is going to boost monetization, not just when it comes to hardware for Apple, but the software and the services as well.
Manus getting ready for his next upgrade. Tom, thank you so much, Tom McKenzie on tech. Okay, let's turn to Washington, D.C. Vice President Harris has raised a record $310 million in July. That's according to her campaign. That gives the presumptive Democratic nominee a cash advantage over Republican nominee Donald Trump. For more, let's bring in Bloomberg's Bill Ferries. Bill, it had been Trump outraising Biden when Biden was still the candidate. Now you have Harris bringing in what they say is grassroots money. What edge does that give Harris after the Democrats had been falling behind Trump?
Well, like you said, $310 million is just a massive haul in July. It's a record for this point in the campaign. And remember, Kamala Harris was not the de facto candidate for the Democrats until the third week of July. It was basically around July 21st. That President Biden said he was stepping out of the race and handing it over or endorsing Kamala Harris as his successor. So $200 million of that was in 1 week. It's hard to believe that kind of a pace can be sustained, but it has eliminated the gap that the Democrats and the Biden campaign at the start of July had with the Trump campaign. At this point, Kamala Harris and her campaign have about $50 million more cash on hand, $377 million for them versus about $327 million for former President Trump. So it is, if you needed any more evidence that it is a changed race, that kind of does it. Now we need to see what happens. There's still 95 plus days to the election, but it's obviously an exciting start, I think, for Harris and her supporters.
So what's going on with Josh Shapiro? Danny saw this line. It's in the New York Times. It's on CBS. Shapiro cancels his Hamptons fundraising activities. There seems to be a coalescence in the betting markets around Shapiro as being that running mate. Is he the front runner for her VP pick?
There's a lot of speculation that he is. It's really, come down to just 2 or 3 names. Pennsylvania is the biggest battleground state with 19 electoral votes. A win there for either the Trump campaign or the Harris campaign would go a long ways towards sealing an election victory. Shapiro, listen, he ran for Attorney General in 2016 and 2020. The presidential candidate for the Democrats those years, Hillary Clinton and Joe Biden. He got more votes than either of those presidential candidates in those years. That normally doesn't happen. Usually votes dwindle as you go down the ticket. It went up for him. So he's obviously drawing people from both parties, and that is one of the big attractions I think he'll have to the Harris campaign. That said, there are other people out there, but right now there's a lot of speculation that he might be in the driver's seat.
Okay, Bill, thank you very much. Bill Ferry's there on the very latest on politics. Very latest on markets from Danny and myself is, you've heard the Intel story, down 20%. But the broader markets are also under pressure today. We're going to get the jobs report. That could be fill or kill in terms of a confirmation bias on the growth scare that you've had. Equities are lower. Danny, we've had the Bank of America report, the flow show. Old school risk off is what Hartnett and the team say there. People underestimate just how much lower rates may need to go to stimulate a weak economy, no longer juiced by government spending. So if you get a rise in the jobs report, a rise in the unemployment rate, let's say, and a withering of the wages, you're going to have to see a little bit more alpha come through again from the Fed. And this is what builds the 50 basis point cut in September.
I think that's so important because you could easily form this argument that goes something like this, that 500 basis points of rate cuts didn't impact the economy on the way up. So who's to say that 300 basis points on the way down is going to be enough to save this market? Just a quick snapshot of bonds before we take you to the break. Bonds continue to rally this morning. Your 10-year yield is back under 4%, 3.9%, 4-year yield 4.1. Okay, coming up, we're going to set you up for the round out of the week. Payrolls, it's coming up in just a few hours' time.
Drum roll. It's Bloomberg Brief. I'm Janus Henderson in New York. Let's check out what is ahead for you today. On the reporting side, big oil earnings from Exxon and Chevron report before the bell. And then it's the main event. It's the July jobs report, 8:30 Eastern time. You're looking at 175,000 and 4.1% on the unemployment numbers. Fed speak returns. Don't miss our interview with the Chicago Fed President, Austin Goolsbee. That is at 12 p.m. right here on Bloomberg Television. We've drumbeat this through the morning. Intel crashes by over 20% pre-market. Sales drop pretty much the biggest share drop in 24 years. Amazon extending its post-earnings slump, spending playbook, risks disappointing investors. And then you've got DoorDash as well, posting strong profit outlook and growth in delivery orders. Look, whatever way you cut this up, the equity markets are in a growth scare and policy error. That is the narrative that they have decided to latch onto, as well as those earnings from Intel and Amazon disappointing the tech market. You are looking at the debate now between whether this is cathartic or whether this is crisis. You will get a confirmation bias from the jobs market later on today. The Russell did choke as well, down over 3% yesterday. NASDAQ down 1.75%. The bond market is on fire. We're up for the 7th day in a row in 10-year government bond yields. So you are just seeing this market begin to price in 3 rate cuts. 10-year yields are significantly low, below the 4% level. So as I say to you, 50 basis points is now something that the market will begin to talk about, and the size and the scale of 2025 rate cuts as well. So the downside bias on the jobs report, we'll see what that number is a little bit later on today. From Dawn in New York, good morning.